What could help investors kind of form their own opinion of what will happen with inflation, how they can better allocate, for their portfolio? Because, sometimes it's hard to really have a full understanding of what's going on. Even over the last decade, maybe people thought there was going to be more inflation than there was, or maybe there actually was, and it's not as measured. And then moving forward, I mean, it's easy to believe, I guess, in all the inflation based on the money printing, but at some point, where does affordability come into play actually in US based on the average household? And, how will the government keep that in balance with the voters and so forth?
The CPI is a number that is produced to help the US government in their entitlement payments and everything else like that. But the things that you most desire in life, whether it's a second home, a great education for your kids, good health care, those types of things, childcare, those types of goods and services are growing at a much, much higher clip than CPI. So anything that the typical person aspires to, it's growing at 7-8% per annum. So that's really the true inflation number. And they can tell you it's much lower than that, but that's really, those are the goods and services that you want and you need in your life. So I would say that to look at it, and the big difference now, as opposed to coming out of the financial crisis of 2008, 2009, the amount of currency that has been injected into the economy is just absolutely staggering. And as I mentioned, it's 25% year over year. And there's no time in the history of civilization where you inject a lot more money into the economy and you don't have a much higher level of inflation. So I would keep an eye on that. So, there's a stimulus package that's coming out. It's going to be $1.9 trillion stimulus package. That money has to come from somewhere. So people need to sit and say, well, where do they get that $1.9 trillion? Well, they're going to print it up, and they print that up out of thin air. And every time you put in more currency out in circulation with more or less the same goods and services available, it results in inflation. So we haven't seen it in reported numbers, but we definitely have seen it in other types of assets. So if you wanted to buy a home in, go out to Long Island in the Hamptons, or the cost of sending your kid to a good 4-year school, there's real inflation there. And I think most people understand that.
So I have also a lot of friends in the residential / multifamily market, and, their projections on their rent increases with inflation, are pretty high for, let's say, the next 5 years. At what point does it become unaffordable for the majority of people? And, what kind of happens? What friction will occur?
Yeah, well, listen, I think what you've seen for the last 30 years is that real household income really has not risen. And that's why you saw this populist movement going on, not here just in this country, but around the world. There's real backlash. And, the recent activity in GameStop stock was kind of a populist movement. And you have this kind of society that developed online, and really was kind of built around, hey, here's an opportunity, but not only is it an opportunity, but it's a way for us to stick a finger in the eye of the elites. So that kind of is already out there, and it's bubbling just below the surface. And that's why, they're gonna try to do this in a way that's going to be tolerable to people. But they really have no choice. They can default on the currency, which is really not a good option, or they can inflate their way out of it, and they're going to have to inflate their way out of it. And hopefully it doesn't lead to more civil unrest and real problems in society here. It's going to be a tricky situation. So, the great thing about this country is that there's been a lot of innovation, and hopefully that, the people, that the true innovators, come out and they develop industries that we're not even thinking about today, and there's going to be growth along those paths, and we can get through this okay. But it's going to be a very trying time for a lot of people. So I think you really need to be paying attention to that. I think you really need to be preparing your portfolios for that, to hedge against that debasement of currency and that loss of purchasing power.
Yeah, I mean, I guess that brings to tech. Do you believe tech is deflationary? Is it bringing down the cost of, certain things?
Absolutely. Yeah. So that's been one of the things that has held down inflationary pressures, but it hasn't held down a lot of things. There's been real financial inflation, right? So a lot of the craziness and the valuations that you're seeing right now has to do with, is it a bubble? And maybe if everything's in a bubble, which is pretty much everything is, it's because your currency is a bubble.
Yeah.
And that's really the issue that's going on right now. So if you look at stock valuations, whether on trailing PEs and cyclically adjusted trailing PEs, it's at close to all-time highs. Market capitalization to GDP, all-time high. So in very, very good sound measures of valuation, there's a lot to be nervous about. On the flip side, the central bank is probably not going to have the ability to raise rates. So maybe, valuations don't come crashing down, but it's hard to see how you're going to make money there. But it's a real issue, and it's something that we're dealing with. I think we're right in how we positioned our funds. I think what I'm saying to you, unfortunately, is going to come back, and you need to be in companies that really can defend themselves for the debasement of the currency and a higher level of inflation is really what the world we're in right now.
I know everyone's trying to form opinion on what interest rates will do because that ultimately affects a lot of different things. So what is your take on the next 5 years, 10 years, 20 years?
So we've been saying for a long, long time, going back to 2008, 2009, that the debt burden is so large that the central bank really doesn't have an option to raise rates aggressively. You raise rates 2-3%, it will choke off the economy very quickly because of the debt burden. And they tried it back at the end of 2018, and the stock market rolled over 20% in a very short period of time. They tried quantitative tightening. That didn't fly. So my guess is that they're going to artificially keep rates very low for a very long period of time. You're going to see probably low rates for 20, 30 years. They're forced to as they continue to print up more money and debase the dollar to pay back and hopefully grow out of it with time. We went through a period like this in the 1940s where the debt burden was so large and they inflated and held rates low. There it was a little bit different. The debt burden wasn't quite as large, and there was, coming out of World War II, you had this ability, and the rest of the world needed to be rebuilt, and they were buying for the United States, so you could get the benefit of that. That's not the case today. So it's a much more challenging environment today than it was in the past.